Why interest rate is basically the opportunity cost of money?
When you lend money or deposit it in a bank, you are sacrificing immediate access to that money for a certain period. The interest rate compensates you for this opportunity cost, the potential gain or benefit you forego by not using the money immediately.
What does the concept of opportunity cost mean for lenders?
When you lend money, the lender incurs the opportunity cost of not being able to use that money during the lending period. The interest rate charged on the loan serves as compensation to the lender for this lost opportunity.
What the implication of lower interest rate?
When interest rates are lower, borrowers are charged less for taking out a loan or using credit. Lower interest rates make borrowing cheaper, which encourages individuals and businesses to take out loans for various purposes. This increased borrowing and spending can stimulate economic activity and boost overall consumption.
How do lower interest rates contribute to economic growth?
Lower interest rates promote investment and business expansion. Businesses are more likely to invest in new ventures and expand their operations when borrowing costs are lower, which can lead to economic growth and job creation.
What is the impact of lower interest rates on the housing market?
Lower interest rates make mortgages more affordable, increasing demand for housing. This can drive up home prices and stimulate growth in the real estate market.
How do lower interest rates affect savings rates?
Lower interest rates can discourage savings because the returns on savings accounts and low-risk investments are lower. Individuals may be less motivated to save and may opt for spending or investing in higher-yielding assets.
How do lower interest rates influence the stock market?
Lower interest rates can lead to increased investment in stocks. As borrowing costs decrease, investors may be more willing to invest in stocks, seeking higher returns than those available in fixed income investments. This increased demand for stocks can potentially drive up stock prices.
How can lower interest rates impact a country's currency?
Lower interest rates can result in a depreciation of a country's currency. When interest rates are relatively lower compared to other countries, foreign investors may be less attracted to holding that currency, leading to a decrease in its value relative to other currencies.
Why don't central banks always lower interest rates if lower rates have many benefits?
Lower interest rates can encourage excessive borrowing, risky investments, speculative behavior, excessive leverage, and a search for higher yields, which can all contribute to financial instability. When interest rates are low, investors may engage in riskier investments to achieve higher yields, which can lead to the misallocation of capital and the formation of asset price bubbles. When interest rates are low, investors may search for higher yields by investing in complex financial products or non-traditional investments with higher risks. These investments may lack proper understanding or regulation, increasing the potential for financial instability. When consumers take on more debt for purchases such as homes, cars, and other goods, the demand boosts, which can lead to higher prices. And it's basically inflation.
How do central banks control interest rates?
Central banks control interest rates through monetary policy tools, such as open market operations, reserve requirements, and the setting of key policy rates, such as the benchmark interest rate or the overnight lending rate.
What is the role of open market operations in controlling interest rates?
Open market operations involve the buying and selling of government securities by the central bank. By buying government securities, the central bank injects money into the banking system, which lowers interest rates. Conversely, selling government securities reduces the money supply and increases interest rates.
How do reserve requirements affect interest rates?
Central banks set reserve requirements, which determine the amount of funds banks must hold as reserves. By increasing reserve requirements, central banks reduce the amount of money available for lending, which can raise interest rates. Conversely, decreasing reserve requirements increases the funds available for lending, which can lower interest rates.
What is the significance of the central bank's key policy rate?
The central bank's key policy rate, such as the benchmark interest rate or the overnight lending rate, serves as a reference rate for the interest rates charged by commercial banks. By adjusting the key policy rate, the central bank influences borrowing costs throughout the economy.
What is a benchmark interest rate?
A benchmark interest rate is a key interest rate that serves as a benchmark for setting other interest rates in the economy. The benchmark interest rate provides guidance for lenders and borrowers in determining interest rates for various financial products. The benchmark interest rate is typically set by the central bank or a financial authority based on economic conditions, policy objectives, and market factors.
What is the overnight lending rate?
The overnight lending rate is the interest rate at which banks lend or borrow funds from each other on an overnight basis. Changes in the overnight lending rate can have a cascading effect on other interest rates in the economy, impacting liquidity levels and financial market stability. The overnight lending rate is influenced by the central bank, but it is primarily determined by the supply and demand dynamics of the interbank lending market.
Why do the benchmark interest rate and the overnight lending rate differ?
The overnight lending rate is influenced by immediate funding needs and market conditions. The benchmark interest rate takes into account broader economic factors and serves as a reference for a wide range of lending and borrowing activities.
What is the difference between the benchmark interest rate and the overnight lending rate?
The benchmark interest rate and the overnight lending rate are not always the same due to differences in their purpose and calculation methodologies. The benchmark interest rate is a broader reference rate that guides the overall interest rate environment in the economy, whereas the overnight lending rate specifically relates to short-term borrowing between banks.
What is the general relationship between the benchmark interest rate and the overnight lending rate?
In normal market conditions, there is typically a positive correlation between the benchmark interest rate and the overnight lending rate, meaning that changes in the benchmark rate tend to have an impact on short-term borrowing costs between banks.
Is there always a positive correlation between the benchmark interest rate and the overnight lending rate?
While there is often a positive correlation between the benchmark interest rate and the overnight lending rate, it is not always the case due to various factors influencing short-term borrowing rates. For example, market conditions, liquidity levels, central bank policies, and supply and demand dynamics in the interbank lending market.
Why might the overnight lending rate deviate from the benchmark interest rate?
The overnight lending rate can deviate from the benchmark interest rate due to short-term market dynamics, such as changes in liquidity conditions, counterparty risk perceptions, or specific factors affecting the interbank lending market.
How do central bank interventions impact the correlation between the benchmark interest rate and the overnight lending rate?
Central bank interventions, such as open market operations or changes in reserve requirements, can directly influence the overnight lending rate and may result in deviations from the benchmark interest rate, depending on the specific policy actions and market response.
What is the commercial banking rate?
The commercial banking rate refers to the interest rates charged by commercial banks on loans and provided on deposits to their customers. Mortgages, auto loans, and business loans are all loans from commercial bank that has direct impact on individual or business.
What factors determine the commercial banking rate?
The commercial banking rate is influenced by the benchmark interest rate, market conditions, creditworthiness of borrowers, and the bank's own cost of funds.
When we see news like Fed increases rates a quarter point, what specific interest rate are they adjusting?
The news about the Federal Reserve, Fed, increasing interest rates typically refers to the adjustment of the federal funds rate. The federal funds rate is often referred to as the overnight interest rate.